The United States has officially crossed the financial threshold that once seemed almost unimaginable. For the first time in history, the total national debt has surpassed $40 trillion. That number is so enormous that it is difficult to picture in ordinary terms. $40 trillion is $40,000 billion. It represents decades of government spending, tax policy, wars, economic emergencies, entitlement programs, interest payments, and political decisions made by administrations and Congresses controlled by both major parties. But this documentary is not simply about a giant number. The bigger question is how the United States reached this point, why the debt continues to grow, and what a $40 trillion national debt could eventually mean for ordinary Americans. To understand the significance of this milestone, we first have to understand what the national debt actually is. The federal government collects money primarily through taxes and other revenues. At the same time, it spends money on programs such as Social Security, Medicare, Medicaid, national defense, federal agencies, infrastructure, veterans benefits, and countless other government responsibilities. When the government spends more in a year than it collects, the difference is known as a budget deficit. To cover that shortfall, the Treasury borrows money by issuing securities such as Treasury bills, notes, and bonds. Over many years, those accumulated deficits become part of the national debt. That means the United States did not suddenly borrow $40 trillion all at once. The number was built gradually over generations. Every recession, tax change, spending increase, military conflict, financial rescue package, emergency program, and interest payment helped shape the total. Some years contributed far more than others, but the overall pattern has remained remarkably consistent. The federal government has repeatedly spent more than it has taken in. There is also an important distinction inside the $40 trillion figure. Most of the debt is considered debt held by the public. That includes Treasury securities held by American investors, banks, pension funds, mutual funds, corporations, the Federal Reserve, foreign investors, and foreign governments. Another portion consists of intragovernmental holdings, meaning money one part of the federal government owes to another. Trust funds connected to programs such as Social Security can hold Treasury securities, for example. Both categories are included in the gross national debt, but economists often focus especially on publicly held debt when evaluating the government's long-term financial position. America has carried debt for nearly its entire history. Borrowing itself is not necessarily a sign of economic failure. Governments routinely borrow to finance major wars, respond to recessions, build infrastructure, or support the economy during emergencies. In certain circumstances, borrowing can even help prevent a deeper economic collapse. The problem begins when borrowing becomes persistent, deficits remain large even during relatively normal economic conditions, and interest costs start consuming an increasingly large share of the federal budget. The growth of America's debt becomes much easier to understand when we look at the last several decades. During the 1980s, federal debt increased significantly as military spending rose and tax policy changed. During the 1990s, stronger economic growth and a combination of spending restraint and higher federal revenue eventually produced budget surpluses for a short period. At the beginning of the 2000s, however, the fiscal picture changed again. Tax reductions, increased military spending after the September 11th attacks, wars in Afghanistan and Iraq, and expanded federal programs contributed to renewed deficits. Then came the 2008 financial crisis. The collapse of major financial institutions, a severe recession, rising unemployment, and emergency government interventions pushed federal borrowing sharply higher. Tax revenues fell as the economy weakened, while government spending increased to stabilize financial markets and support households and businesses. The national debt climbed significantly during the years that followed. But even that period was eventually overshadowed by what happened during the COVID-19 pandemic. In 2020, much of the economy suddenly shut down. Businesses were forced to close or reduce operations, unemployment surged, travel collapsed, and millions of families faced economic uncertainty almost overnight. Washington responded with an extraordinary wave of emergency spending. Stimulus payments were distributed to households. Unemployment benefits were expanded. Businesses received financial assistance. Healthcare systems received emergency support. Federal agencies launched programs designed to prevent a temporary health crisis from turning into a complete economic depression. Those decisions helped support the economy during an unprecedented emergency, but they also required trillions of dollars in additional borrowing. The debt increased dramatically during that period. When the pandemic eventually faded as the dominant economic emergency, however, federal deficits remained extremely large. That is one of the central reasons today's debt debate is different from previous episodes. The United States is no longer running massive deficits only during wars or severe recessions. Large deficits have increasingly become part of the normal federal budget. The speed of the recent increase is particularly important. The national debt crossed $38 trillion in late 2025, passed $39 trillion in early 2026, and then reached $40 trillion only months later. In other words, another $1 trillion was added in a remarkably short period of time. That does not mean exactly $1 trillion was spent on a single new project or program. It reflects the combined effect of ongoing government deficits, interest costs, revenue collections, spending obligations, and Treasury borrowing. At the heart of the problem is a simple mathematical imbalance. The federal government continues to spend substantially more each year than it receives. Imagine a household earning $80,000 annually but consistently spending $110,000. The family could use credit cards or loans to cover the gap temporarily, especially if lenders trust that the household has strong future income. But if that pattern continues year after year, the debt grows. Eventually, an increasing portion of the household's income must go toward interest rather than current needs. The federal government is obviously far more complicated than a household and has powers that individuals do not have, but the basic concept of recurring deficits remains similar. This is where interest payments become one of the most important parts of the story. For many years, the federal government benefited from historically low interest rates. That made borrowing huge amounts of money relatively inexpensive. But when interest rates rise, newly issued Treasury securities become more expensive for the government to finance. Older debt also eventually matures and has to be refinanced. If that old debt was issued at very low rates but must now be replaced with higher rate debt, the government's interest expenses rise even if lawmakers do not create a single new federal program. Federal interest costs have now reached levels that would have been considered extraordinary not long ago. The government is spending enormous amounts simply to service existing obligations. That money does not directly build a bridge, fund a school, purchase military equipment, provide healthcare, or send a retirement benefit. It is the cost of financing previous borrowing. And as the debt grows, that cost can grow with it. This creates what economists worry could become a dangerous cycle. Larger deficits require additional borrowing. Additional borrowing increases the total debt. A larger debt can produce larger interest payments. Those interest payments increase government spending, which can create even larger deficits. Those deficits then require still more borrowing. The cycle does not necessarily produce an immediate crisis, but over time it can make the country's fiscal situation increasingly difficult to manage. The United States still possesses several enormous advantages. The American economy remains one of the largest and most productive economies in the world. The US dollar remains the dominant international reserve currency. Treasury securities are deeply integrated into the global financial system and are widely viewed as among the world's most important financial assets. Investors across the globe continue to purchase American government debt. These advantages give Washington far more borrowing capacity than most countries. But those advantages do not make the debt irrelevant. Investors still care about inflation, interest rates, fiscal policy, economic growth, and political stability. If buyers of Treasury securities believe lending money to the US government carries greater long-term risk, they may demand higher yields. That means Washington has to pay more interest to attract buyers. Even a relatively modest increase in average borrowing costs can become extremely expensive when applied to tens of trillions of dollars in debt. Higher Treasury yields can also affect the broader economy. Government bond yields influence financial markets throughout the United States. Mortgage rates, corporate borrowing costs, business loans, and other forms of credit can all be affected by movements in Treasury markets. That means the national debt debate is not limited to politicians in Washington. Over time, federal borrowing conditions can influence the cost of buying a home, expanding a business, financing investments, or borrowing money throughout the economy. There is another issue that rarely receives enough attention: opportunity cost. Every dollar spent on interest is a dollar that cannot simultaneously be spent somewhere else unless the government raises more revenue or borrows additional money. As interest expenses consume a larger share of the budget, future lawmakers could face increasingly painful decisions. Should taxes be raised? Should defense spending be reduced? Should domestic programs be cut? Should retirement programs be restructured? Should healthcare spending be changed? Or should the government simply keep borrowing? Those questions are politically explosive because nearly every major category of federal spending has a powerful constituency. Millions of Americans rely on Social Security. Medicare provides healthcare coverage to older Americans. Defense spending supports national security and millions of jobs connected to the military and defense industries. Medicaid supports lower-income households. Federal agencies provide services ranging from aviation safety to food inspection. Cutting spending sounds simple until lawmakers have to decide whose benefits, programs, or services should actually be reduced. Raising taxes is equally difficult. Many Republicans argue that the fundamental problem is excessive government spending and that higher taxes could weaken investment and economic growth. Many Democrats argue that federal revenue is too low relative to the country's commitments and that tax reductions, particularly for corporations and higher-income households, have contributed significantly to deficits. Economists themselves disagree about the ideal balance. Some emphasize spending restraint. Others emphasize additional revenue. Many argue that stabilizing the debt will eventually require a combination of both. That leads to another important point. The $40 trillion debt cannot fairly be blamed on one president or one political party. Republican and Democratic administrations have both added trillions to the debt. Congress has repeatedly approved spending and tax policies that contributed to deficits. Major emergencies occurred under presidents from both parties. The debt is the accumulated result of decades of decisions made across the political system. Presidents can propose budgets and policies, but Congress controls federal spending and taxation. At different points, One party has controlled the White House while another controlled part or all of Congress. In other periods, the same party controlled both branches. Yet the long-term trajectory has remained upward. That suggests America's debt problem is not simply the product of one political ideology. It reflects a deeper structural challenge in American government. One reason is straightforward. Voters often support programs that benefit them while opposing the taxes necessary to fully pay for those programs. Politicians understand that reality. Promising benefits can be popular. Raising taxes or cutting established programs can be politically dangerous. Borrowing allows elected officials to postpone that conflict. The government can provide services today while shifting part of the cost into the future. For a while, that approach can appear painless. Roads are built. Checks are sent. Government programs continue operating. Taxes remain lower than they otherwise might be. But debt does not eliminate the cost. It changes when and how the cost is paid. One of the most common questions surrounding the national debt is whether the United States could actually go bankrupt. The answer is more complicated than a simple yes or no. The federal government is not like a company or household because it issues debt in a currency that it controls. The United States has extraordinary taxing authority, a massive economy, and the ability to issue dollar-denominated securities. That makes a conventional bankruptcy scenario extremely different from what could happen to an individual, corporation, or country borrowing heavily in a foreign currency. But that does not mean there are no limits or consequences. If confidence in American fiscal policy weakens significantly, investors could demand substantially higher interest rates. Excessive money creation could contribute to inflation. Political battles over the debt ceiling could create fears about delayed payments or technical default. Financial markets could become unstable. None of these outcomes require the United States to literally run out of dollars. The more realistic danger is gradual deterioration. Interest payments become larger. Fiscal flexibility becomes smaller. Congress has fewer options during future emergencies. Investors demand more compensation. Economic growth may be pressured by higher borrowing costs. Eventually, government leaders are forced to make difficult choices that become more painful precisely because they were delayed. Consider what happens when the next major emergency arrives. The United States has historically relied on massive borrowing during crises. During World War II, the government borrowed heavily to finance the war effort. During the financial crisis, borrowing supported emergency interventions. During the pandemic, federal borrowing helped prevent economic collapse for millions of households and businesses. Having the ability to borrow during a crisis is one of the government's most powerful tools. But entering each new crisis with a heavier debt burden and higher interest costs could limit that flexibility. Economists often refer to this concept as fiscal space. A country with strong finances has more room to borrow aggressively when something extraordinary happens. A country already carrying enormous structural deficits has fewer comfortable options. This is why the national debt should not be viewed only through the question, can America afford $40 trillion today? A more important question may be, how much flexibility will America have at $45 trillion, $50 trillion, or beyond when the next recession, war, pandemic, or financial crisis appears? Demographics add another layer to the problem. The American population is aging. As more baby boomers retire, the number of people receiving Social Security and Medicare benefits increases. At the same time, growth in the working-age population is slower than it was during earlier periods of American history. That means fewer workers relative to beneficiaries can place greater pressure on programs financed largely through payroll taxes. Healthcare costs are another long-term challenge. The federal government spends enormous amounts through Medicare, Medicaid, Veterans Healthcare, and other programs. Even modest increases in healthcare costs, multiplied across millions of people, can significantly affect future federal spending. Then there is economic growth. Stronger growth can make a large debt easier to manage because government revenues typically increase as incomes and business activity rise. This is one reason economists often compare debt to the size of the overall economy rather than simply looking at the dollar amount. A $40 trillion debt would be far more dangerous for a small economy than for an economy the size of the United States. But relying on growth alone is risky. The economy would need to expand fast enough to outpace the growth of deficits and interest costs. If debt continues rising faster than the economy for decades, the burden becomes increasingly difficult to stabilize. Could technology help change the picture? Possibly. Artificial intelligence, automation, advanced manufacturing, energy innovation, and other productivity improvements could produce stronger economic growth and higher tax revenues. A productivity boom similar to previous technological revolutions could make future debt easier to carry. But future breakthroughs cannot be treated as guaranteed solutions to today's fiscal imbalance. Inflation also has a complicated relationship with debt. Moderate inflation can reduce the real value of previously issued fixed-rate debt. But high inflation creates its own serious problems. It reduces purchasing power, destabilizes households and businesses, and often forces the Federal Reserve to raise interest rates. Higher rates then increase the government's cost of borrowing. Attempting to inflate away the debt could therefore create consequences just as serious as the debt itself. Another proposal is simply cutting government spending dramatically. In theory, reducing spending could shrink deficits. In practice, the numbers make this difficult. The largest federal programs are politically sensitive programs such as Social Security, Medicare, Medicaid, defense, and interest payments. Significant deficit reduction through spending alone would eventually force lawmakers to confront some of these major categories. The same problem applies to tax increases. Raising federal revenue could reduce deficits, but large tax increases can affect households, businesses, investment decisions, and economic activity. The central debate is therefore not whether there are solutions. There are many possible solutions. The challenge is finding a combination that is economically sustainable and politically acceptable. History demonstrates that America's fiscal trajectory can change. During the late 1990s, the federal government briefly ran budget surpluses. Strong economic growth, higher tax revenue, spending restraint, and political agreements all played a role. That period shows deficits are not inevitable. But today's circumstances are different. The population is older, entitlement spending is larger, healthcare obligations are greater, and interest costs are significantly more important. The $40 trillion milestone should therefore be viewed as more than a dramatic headline. It represents an accumulation of choices. Americans demanded government services. Lawmakers created programs. Presidents signed legislation. Congress reduced taxes at various times. Wars were financed. Recessions were fought. Banks were stabilized. Businesses were rescued. Families received emergency assistance. Interest accumulated. And each generation passed part of the resulting obligation forward. Perhaps the most remarkable part of the story is how normal the debt has become. Numbers that once would have dominated political debate now pass quickly through the news cycle. $20 trillion once sounded enormous. Then came 25 trillion, 30 trillion, 35 trillion, now 40 trillion. With every milestone, the numbers become harder for people to emotionally understand. But mathematics does not become less important simply because the numbers become difficult to imagine. The United States does not face an unavoidable financial collapse simply because the debt crossed $40 trillion. America remains an enormously wealthy country with deep financial markets, valuable assets, global economic influence, and powerful institutions. Predictions of immediate national bankruptcy misunderstand how sovereign debt and the dollar-based financial system operate. At the same time, dismissing the debt because America has always managed to borrow would be equally misleading. The risk is not necessarily a dramatic collapse tomorrow morning. The greater danger may be a slow erosion of choices. More federal revenue goes toward interest. Future budgets become harder to negotiate. Emergency borrowing becomes more expensive. Economic policy becomes increasingly constrained. That is what makes the $40 trillion milestone historically important. The debt clock measures dollars, but behind those dollars are political decisions about what Americans expect from their government and how much they are willing to pay for it. There are no magical solutions. Cutting spending has consequences. Raising taxes has consequences. Allowing the debt to continue growing has consequences as well. Eventually, those trade-offs become impossible to postpone. For decades, Washington has often chosen the easiest short-term answer: borrow the difference and deal with the consequences later. Now the United States has entered the era of the $40 trillion national debt. The real question is not whether the debt clock will continue moving. Unless major changes are made, it almost certainly will. The real question is what happens as interest costs rise, the population ages, government obligations expand, and the country encounters its next major crisis. Will faster economic growth make the burden manageable? Will lawmakers finally reach a bipartisan agreement on spending and taxes? Will Washington continue borrowing until financial markets force a change? Or will the United States discover a completely different path forward? Nobody can answer those questions with certainty. But one thing is clear. $40 trillion did not appear overnight. It was built one deficit, one emergency, one political compromise, and one borrowing decision at a time. And whatever comes next will be built the same way. The United States has reached a milestone that once seemed almost impossible. $40 trillion in national debt. It is not the end of the American economy. It is not proof that the country is about to collapse. But it is a warning that the decisions being made today will shape what future generations inherit tomorrow. And perhaps the most important question facing America is no longer how the country reached $40 trillion. It is whether Washington will change course before the next historic milestone arrives. If you found this documentary informative, subscribe for more original documentaries examining the biggest economic, political, and financial stories shaping America and the world. And tell us in the comments, do you believe America's national debt has reached a dangerous level? Or does the strength of the US economy mean the country can continue managing it?